The key distinction in India this time is we find ourselves in a 2020 pandemic related crisis at the same time as we have a version of the 2008 financial services crisis that rest of the world suffered in 2008.
That was Narayan Ramachandran. Listen to Narayan talk about the twin crises that have hit the Indian economy in 2020.
Welcome to BIC Talks, a podcast brought to you by the Bangalore International Centre. BIC has fostered over 250 informed discussions, dialogue, and cultural enterprise in its new premises since 2019. BIC Talks bring ideas and conversations ever closer to you.
Hi, I'm Pavan Srinath and welcome to BIC Talks. This is our fourth episode on various aspects of the COVID-19 pandemic. Today, columnist, emerging markets investor, and polymath Narayan Ramachandran joins me to help us understand how the global and the Indian economies have been affected by the pandemic and the path we need to take to get to a new normal. Narayan, welcome to BIC Talks.
Thank you, Pavan. Pleasure to be here this rather weird and unusual time.
So, Narayan, we're in the midst of this global and national economic crisis as well, while we have this pandemic and health crisis that the world is dealing with. And here in India, though, is this the only economic crisis that we're dealing with?
Let me first talk about the world economy and then I'll sort of dovetail it into the Indian one, just so that there is context to where we are in India. And to begin with on the global economy, let me start with a frame. Frame is that I think we are sort of in the same position that we were in a global context between the Great Depression of 1929 and the World War that followed from 1939 onwards. So they were separated by a decade. One was a very economic event, the 1929 Depression. Obviously, the World War that went from 1939 to 46 was a non-economic event that caused a serious disruption in the global economy. So I think the parallels are not identical, but there is a certain similarity between where we were in 2008 and now. So 12 years apart from 2008, in 2020, we find ourselves in a non-economic crisis, if I can call it that, and a disruption that will last hopefully only a few months, not the 6 years of the war, but has sort of similar effects. And I say similar effects because the disruption that the war caused to supply chains, to livelihoods, to businesses is the same kind of economic impact that we are beginning to see and will continue to see from this disruption due to the pandemic. Also, the war was, in consequence at least, if not at the beginning, an inflationary event. And by the time this is all over, I think you will see that both through monetary and fiscal policy, that this would have turned out to be a fundamentally inflationary event. Obviously, an inflationary event that is attempting to recover the world from recession and unemployment and so on. And so it may not manifest itself as continuous inflation, but a world that will begin to be inflationary as a consequence of all of the actions that are beginning to be taken in the G7 and even outside the G7 in countries like India. Now, one other difference is that in 2008, the financial services sector in much of the world was in trouble. Not so in India, but the rest of the world, and particularly the Western world, the financial services sector was in trouble. So the key distinction in India this time is we find ourselves in a 2020 pandemic-related crisis at the same time as we have a version of the 2008 financial services crisis that rest of the world suffered in 2008, but we have been in a slow boiling frog kind of syndrome for the last 5 or 6 years. And that crescendo was sort of reached late last year, even prior to this crisis. So in summary, India has both a 2008 financial services crisis and a 2020 pandemic crisis versus the rest of the world, which is primarily dealing with only a post-COVID kind of situation.
Thanks, Narayan. So this is interesting because when we look at the pandemic as a global health crisis, the closest parallel that we get to is the 1918 Spanish flu, right? I mean, none of the other epidemics that we have seen, outbreaks that we have seen as deadly as they were, spread as widely. And of course, in 100 years, we've made a lot of progress when it comes to medicine, healthcare, public health, and so on, right? But I like that you draw the parallel to the World War and the Great Recession. And here in India, since we have not yet recovered from everything that happened in the country after the financial crisis, where were we when the pandemic was yet to hit us?
Indulge me a moment of history. I think it'll be useful. So going into 2008, actually March of 2008, when Bear Stearns went down, and then subsequently in September when Lehman went down, and that tipped the whole Humpty Dumpty over. India had actually come off of a spectacular 6 or 7 years. Some people may not even remember that our currency was extremely strong in the low 40s. Our foreign exchange position was solid. Our revenue deficit was not a deficit, was actually more or less in equilibrium, a minor surplus, if you will, which hasn't happened for a very, very long time in India, either before or after, and so on. So India was in actually a very, very strong wicket going into the 2008 crisis. In addition to that, we had some accidental fiscal stimulus, such as the pay commission of 2008, 2009, that ended up giving a bit of fillip in a difficult moment through the transition period of 2008, 2009. So bizarrely, India actually skated through the 2008, 2009 crisis relatively less affected than most other countries. Of course, exports were affected. Of course, there was a generalized lack of liquidity and so on. But beyond that, the economic impact on India was modest. India's economic doldrums and difficulties really started first with the crony capitalism of UPA 2, and then subsequently followed by completely unimaginative reform processes followed under first Modi 1 and then Modi 2. So we've had now 6 or 7 years of a banking system that has slowly, with every month, every week, become worse and worse, and to a point where we are now, give or take, in $100 billion hole. 7 lakh crores of 7 trillion rupees of equity infusion required into our banking system, simply for it to become functional and normal again. And that's not to mention the governance aspect of banking. To that, now we need to add a real economic crisis. We'll get to that economic crisis in a second. But look also where we find ourselves. Frankly, the only 2 positive things we have going into this crisis is, one, we have a very positive foreign exchange reserve balance at about 480 billion. Very positive indeed. And second, fortunate part as a consequence of this crisis, oil price has really gone down substantially, which will really favor our balance of payments and our annual bill through our current account. So those are 2 major positives, but pretty much everything else, anemic growth, even where there is growth, what they say, employee-less growth, and investments that are not forthcoming in the economy. So if you think of economy as C plus I plus G, none of the 3 engines was really firing, with the government trying a little bit to compensate for it all. We enter this crisis in a really tough spot, mostly from the banking crisis, but also a little bit from a telecom crisis of our own doing, and from a power distribution crisis, balance sheet crisis that we haven't done much about. So those are the 3 big balance sheet crises we have, in addition to overall anemic growth and no single engine of economic growth contributing to overall economic growth. So very, very different situation from where we entered the crisis in 2008.
Can you, one, walk us through what might have happened in the last 3 months and how we should start thinking about the economy when we go into lockdown?
So this is a tough one, Pavan, because it is truly unprecedented in the world that pretty much everything has shut down at the same time. Of course, there are major positives like that to the environment, to automobile emissions and so on, that are a minor positive consequence of lockdown. But the lockdown has enormous effects. I mean, the economy in some senses is like a blast furnace. You can't turn it off and then expect it to turn on again just on a dime. Of course, that's the long scholarship and lessons from the Spanish flu, as well as from other economic crises of the past, is that you need to handle the issue first before you move on to how to tackle it. While there is a lot of debate about should we let things go and should we let herd immunity build and is the cure more expensive than the problem and so on, these are not useful observations because there is much scholarship to suggest and lessons from the past to suggest that you have to handle, at least in substantial measure, the issue at hand, which is the progression of the disease before you get to handling anything else. Of course, the earlier you start handling the progression of the disease and more strict you handle that progression, the better off you are. And India is sort of okay on that front. We started relatively early, I underscore relatively early, and our implementation was relatively strict. Again, the word relative is operative. But on both counts, I think we were doing okay till we had one or two incidents, particularly the one out of Nizamuddin. But so far, I would say to you that we have to handle the exponential growth of the disease before we can handle the economy. I'm not under any illusions about that. The last country which attempted to let it go completely, which was Sweden, has begun to impose restrictions now. So it's a false choice that you can let everything go and then fight. Now, on the other hand, given the advantage of time and a relative flattening of the curve, you can use that time quite effectively in one, tackling the spread, and two, putting in place elements of the economy that need to come back one after the other as this lockdown either staggers to an end or comes to an end. Unfortunately, we are not privy to that planning, and we have not heard too much about that just yet in India. So neither the systematic public health response after lockdown nor the systematic sort of enable the essential economy after the lockdown. Details of neither are forthcoming as of this point, but we will need extreme systematism and detail on that front for us to make the transition from relief, which is the sort of the stage we are in now, to reconstruction and rebuilding, which is the stage we will enter post the lockdown.
Thanks, Narayan. So could you give us a sense just in these 21 days, right? So we had uncertainty before then. You had various states issuing various rules, which is sort of curtailing movement. We didn't have a full lockdown in place, but we had certain restrictions that started coming in. And now we are actually recording this, I think, on day 15 of the 21-day lockdown. So what does the 21-day lockdown do to businesses, the formal and the informal sectors, the banking system and more? How do costs and revenues change when things get locked down?
There's two parts to your question. One you asked and one you didn't ask, Pavan, which is what is in the immediate future and then what is the long future?
I'm also talking about right now, right?
Two ways to think about it, right? In order to protect the immediate future, you could not have the lockdown, which is clearly not a good response. On the other hand, you have to balance how long a lockdown it is. So I think it's a little early to determine how long the lockdown will be, and I don't certainly want to speculate on it. I don't have all the information. But I think one of the parameters that will be used is the rate of the exponential growth. And so something like doubling every 8 days or so will have to be achieved before lockdown is completed. And so I don't know whether we are there quite yet. And maybe we will only know in the next 3, 4, 5 days whether we have reached it, because the full impact of the lockdown on the public health side of it will get known literally as we speak over the next 3 or 4 or 5 days. So we will await that information. In the meantime, as you probably know, the lockdown went into effect on March 25th. And thereafter, pretty much activity, except for a few essential services, have gone to zero. Even prior to that, many businesses had started a work from home, and as a consequence, revenues had started declining quite substantially. So revenue for business after business is nearly zero. Maybe it's 10 or 20% if there's some residual sort of annuity-related contracts, but it is between an 80 and 100% decline on revenue. Of course, that implies that everybody is trying to do something with cost. So depending on what kind of businesses you are in, I have seen, at least on the boards that I serve on, reductions that range from 20% to 80% on compensation, and a suspension of rental payments for at least the period of lockdown, and a discussion on rental payments, particularly where physical infrastructure is involved, that suggests that for the foreseeable future, they tie rental payments to revenue rather than have it be fixed costs. Typically, given India's heavy services orientation, the compensation bucket and the real estate bucket are the two big components of cost. And in the context of zero revenues, those are the two costs that you have to handle. Now, the third cost, depending on how much debt you have on the capital structure, could be the cost of financing. And the RBI has announced a moratorium on EMI payments that is, and I'm going to use the word discretionary within quotation marks, but there is still significant confusion in the markets as to who is it applicable to and in what mechanism. There seems to be widespread agreement that it is applicable to consumers. So if you're a consumer with a credit card payment, it is very likely applicable. But to NBFCs, which are a major element of transmission, some banks to corporate customers and so on, there appears to be some confusion about the amount of discretion that the boards of these banks and NBFCs will have as they pass it on through the system. So we do need to eliminate that confusion if we are to go forward. That is a minor liquidity support. Of course, you have to pay for it as the loan gets extended and so on, but at least it is relief in the short term. So in a very, very short term, cash is king. Those who have a good balance sheet in the context of a poor P&L, which almost everybody is going to have, and certainly a consumer business will have, that the path forward from here will have to look at those businesses that can survive for now an unknown period of zero or low revenue.
That's a fairly bleak picture, but it is what I think we're all seeing. If I got this right, we have seen a reduction in perhaps costs and pay to staff in various places because, again, revenues vanished. There's been a reduction or delays in rental payments and hopefully some action where, loan repayments and so on, either at the retail level or elsewhere, there is some kind of moratorium or some kind of relief that might be there, right? So the three big costs that we as individuals face, as companies face as well. So in this, how long do you think people can survive? And we are still talking about the formal sector, right? And the moment we go to the informal sector, then we don't know how to think about credit. Everything changes. So how dire a situation do you see there when revenue just vanishes?
This is the dovetail between the short and the medium term, Pavan. So on the one hand, you could get things off going again. But if the pandemic continues to wreak havoc, getting 20% of revenue for 6 months is less optimal than getting 0% revenue for 2 months and then going back to 60, 70, 80% revenues as things come back to normal. So I think, therefore, this false choice of a trade-off where the pandemic is not controlled and you go back to an economic view of things is not a valid argument. The goal will be to control the pandemic as quickly as possible. And in so doing, then allow the economy on a medium term to come back. So I think everybody is building scenarios on it as opposed to knowing exactly what to do. But I would say nobody has a scenario that lasts beyond 4 or 5 months. And the logic of that simply is that that's human ingenuity, both in terms of the protocol for how you treat this, as well as perhaps the first stages of vaccine, etc., will make their presence felt sooner rather than later. And the turn of news will indeed get better, which is a useful thing to know when we talk about markets in a few minutes. But I would say to you that I don't think lockdowns are sustainable beyond, pick a number, 8 weeks, 9 weeks at the absolute maximum. So I would say the range of lockdowns would be 3 to 9 weeks, depending on how severe and how hot that particular spot is, but very unlikely to go beyond that kind of number. And therefore, zero revenue is sort of being planned for April and May, and then a limp back. And then when you limp back, different sectors will limp back at a different speed. The consumers and other services sector will be slow relative to some other sectors that might come back a lot quicker.
Thanks, Narayan. Couple of follow-ups on that, and I'll go sort of one by one. First, so is my takeaway correct that it is not a dichotomy between should the state be helping banks versus businesses versus people at various income groups? And is that a false sort of separation and a dichotomy because all of them are actually interlinked in a variety of ways?
Absolutely. I think it's a completely false dichotomy, and particularly the financial services sector is the transmission of both monetary and fiscal, I'm going to call it reform, but let's just call it monetary and fiscal spending. And if you have a dysfunctional financial services sector as we do, it is unlikely that you can transmit your ideas even if you put the money in. So you simply won't be able to implement whatever it is that you want to implement if your financial services sector is dysfunctional, as I think it is in India. So it's a false dichotomy that we can do this or that, and we can conserve money by doing more for this and less for that. I don't think we can do all of that. The way I describe it is we need a banking system rescue plan. Think of it as a TARP, which was done in 2008 in the US, and a Marshall Plan, which is a large-scale fiscal response. But the large-scale fiscal response also comes with governance mechanisms. People don't talk much about the governance mechanisms that came together with the Marshall Plan, but we need governance mechanisms. So, for instance, even money in the banking sector is of little use if the governance system for PSU banks remains the same. So we will need both governance reform and money in the banking system. Fortunately for us, there are many models, including the PJ Nayak report on banking system. We can easily follow some things that have already been written and out there, but we need to have both the political will and the desire to do both the spending of the money and the governance reform, because otherwise it's going to just be a waste of money, or it's going to be ineffective, or both.
Thanks, Narayan. Especially about the banking sector, I think you've been talking about and writing about the $100 billion hole in the Indian banking system. And perhaps that $100 billion number has grown even more, right? And I'm hoping that at least during this time of pandemic and this new crisis, there is the necessary urgency that drives reform along with sort of filling that hole, because otherwise, like you said, it will have a minimal impact.
Yeah, let me illustrate why you can't target the response too much. Take the banking system as an example, right? If we create a TARP which allows for toxic assets to essentially leave the balance sheet, then to some extent it actually does bail out the equity holders, right? So you could be sanctimonious and suggest that equity holders should go to zero for a bank that performed poorly. But that's neither here nor there. The answer has to be that you get this thing moving, and you get this moving for the benefit of the entire economy and for the country. And in order to do that, there is a disproportionate return to the equity holders. It won't be huge, but it's not that they're going to zero. So exactly what happened to Yes Bank, I don't know whether you followed that. But the Yes Bank equity holders did not go to zero. They went to some residual value. Now, you can sit there and argue till kingdom come that was unfair and all of that. But on the other hand, it's a way to continue to move on. And therefore, I do think we have to take a greater good, a Benthamian argument, a greater good of the greater many, rather than sit around trying to be precise and measure our response in a manner that it only goes to those who need it. Now, of course, there is a certain section of the population that needs income support because we don't have unemployment insurance, or more particularly because we cannot target unemployment insurance in the same way that some of the developed countries can.
We barely understand what unemployment is, right? Because there's unemployed, there are people who have retreated completely from the job market, people who have never wanted to enter the job market because of a variety of reasons. And yeah, we are in a very different soup compared to the idea of unemployment, which is a fairly Western one, right? That most of us are familiar with.
Yes and no, but if you transfer that to household income instead of the fancy term called unemployment, and you said a household was earning 25,000 rupees prior to this crisis, and now they're earning either nothing or earning, let's say, half that amount, basically, and they have two kids, and they basically making ends barely meet with 25,000 rupees of income, then that income gap needs to be provided by somebody. And that is the nature of a targeted, you can call it universal income, you can call it generalized insurance for income gap. It doesn't matter what you call it. But you need to fly in through a direct benefit transfer, half that income if the income loss is half, for a period of time. It doesn't have to be for a very long time, and say 3 to 4 months before you can cut that in half for the, say, following 2-3 months, and then it goes to zero or something like that. I think we will need to figure out these kind of mechanisms. Now, we do have the ability to do some of that direct benefit transfer, but rather than get too cute and try to figure out exactly who will get what, I think you just have to do a lot of basic income kind of insurance across the board to as many people as you can. All of that costs money, and all of that is inflationary, or can be inflationary depending on how you finance it. So the implication is that you will have a much larger fiscal deficit in both the next year and the year after. That's number one. Number two, the rupee is going to take it on the chin. Very likely will decline to, I don't know, pick a number, 90 or worse. And you will see all other kind of impacts that typically associated with a little bit of both monetary and fiscal spending that is in excess of what a normal economy would need. Now, therefore, the RBI has initially to be very relaxed, and then subsequently needs to be very vigilant because they need to act slightly ahead of the game to keep that sort of within a corridor. Now, I don't know whether the MPC-based corridor of 2 to 6 is realistic, but I don't know whether the 4 going to 3, which is the median number, is realistic anymore. So we may need parliamentary action to relax the median a little bit on the MPC. But that is what an MPC, sorry, I'm using the acronym, but that's the Monetary Policy Committee. And the Monetary Policy Committee was put in place in part to reflect the political objective at the same time as reflecting a monetary objective or a technocratic objective. So the Monetary Policy Committee can function to reflect political objective as well. And the political objective has to be income support in the initial phases, followed by investment and reconstruction, followed by managed inflation in sort of that broad timeline.
Thanks, Narayan. Do you have a rough order of magnitude idea of what kind of resources this will cost?
As we discussed, the banking sector part of this is about $100 billion. So $100 billion, you can think of it as 2 to 3% of GDP. And in my view, I think you will need a fiscal response that is 5, 6, 7% of GDP. So pick a number that's double that number. So that's another $200 billion. And I'm using dollars here because the rupee is going to change its value quite dramatically, even in the period in which we discuss it. So
it was, I think, 75 today morning. I have no idea what it will be by the time this episode airs.
So, I mean, maybe not right away, but sooner rather than later, it's going to slip. So I would say to you that we need something of the order of 7 to 10% of GDP. Now, the common criticism to that is simply following what the West has done. As you all know, the West, the G7 in particular, has put in place already something that is akin to 10% of GDP, and we shouldn't blindly follow it. I completely endorse the idea that India should not do what the West is doing simply because they're doing it. But on the other hand, we don't need to wholesale borrow the solutions from the West, but elements of study and scholarship of past recessions, past pandemics, I think we can borrow those. And we need to craft those elements into our own solution. And my sort of jigsaw puzzle still suggests that we get 5, 6% of fiscal deficit required from that. Now, whether we spread that over 18 months or we keep that well within a year is something we can talk about. And the more that it can be more like a Marshall Plan, where we're actually building productive assets, bridges and roads and ports and tracks and electrification and that kind of thing, as opposed to just services and pensions and government compensation, I think the better off we will be. But my sense, therefore, is 8 to 10% of GDP, 5-6% fiscal, and 2-3% for the banking system. Now, some of the fiscal can come in the form of FDI if properly structured. So we don't need to print 10% of GDP, so to speak. We can actually get some of it in as an investment. But that requires both convening power, coordination, talent, and the will. And I don't know whether that's a trinity of things that we are going to show after this.
Thanks, Narayan. Sometimes I get lost in percentages of GDP, but I think 8 to 10% of GDP would be roughly half the size of how much taxes all governments in India combined collect, right? Which is, 16% of GDP or so. So we are talking something that is 75% of the union government budget, roughly speaking. So Narayan, then the final question, how do you see markets, the people who are investing, especially those of us in the middle class, from retail investors to larger investors? Any quick final thoughts on how they're looking at this?
I don't know. For those of who have followed markets relatively closely, there was a low on March 23rd. I think the March 23rd low will likely hold in global market, even if there is in market speak a retest on the Dow or on the S&P 500 or any of the global indices in the US and Europe and other places. I think they will hold. But in India, we will have to see whether the March 23rd low holds. The reason I say that is India's progression post the lockdown is not yet clear, as we discussed very early in this conversation. We will know over the next 4 or 5 days. I do think if the doubling rate comes down below 8 days or 9 days, it is rather likely that a bottom will hold at the bottom of March 23rd. If not, and the crisis gets the better of us for a while longer, then we may go down to further depths. Now, coming out of this, I do think that the best sector that is hedged against an inflationary or quasi-inflationary outcome is the high-quality financial services sector, which by its very nature of the cost of its own capital and the loans that it makes is sort of hedged to inflation. And any sector that is, broadly speaking, exposed to the currency for all the reasons we spoke about on the currency a few minutes ago. So I do think those two sectors will likely come out of this when we hit the bottom. We will hit the bottom of March 23rd, and it will hold if the pandemic is controlled. And I define the control of pandemic as a doubling rate that is lower than 8 or 9 days.
Narayan, thank you so much for this expansive discussion and trying to help us understand from the big picture and from historical context what this pandemic can mean for the Indian economy and for the world economy. Thank you so much for joining us on BIC Talks.
Thank you, Pavan.
Thank you for listening to this episode of BIC Talks. You can get our podcast on our website, bangaloreinternationalcenter.org, or wherever you get your podcasts. Tune in for new episodes every week. Check out Bangalore International Center on YouTube, Instagram, Twitter, and Facebook. And don't forget to regularly check in on our podcasts.